Welcome to the Simardone Show. I'm your host, Aidan Simardone. Right now, it feels like the world is on the edge of a cliff with the Strait of Hormuz under Iran's control. Hardly any oil is getting out, leading to an energy crisis. To break this down for us is oil market analyst Rory Johnston, who is the founder of the research platform Commodity Context, where he provides data-driven analysis on global oil markets. We'll be delving into the geopolitics of it all and whether you should cancel your upcoming summer trip. Rory, welcome to the show.
Thanks for having me, Aidan.
So right now, many people are paying almost record prices at the gas station. How did we get here?
Yeah, so let's kind of unpack what's currently happened over the past 3 or so months now. So at the end of February, many listeners are likely aware of this, but let's just sort of rehash the basics. At the end of February, United States and Israel launched the Iran war, started the Iran war. And on the first day, Iran retaliated by effectively closing the Strait of Hormuz. The Strait of Hormuz is the single most important oil choke point, or essentially the main artery of oil to the global oil market. Out of a total oil market of roughly roundabout 100 million barrels a day. So we'll keep the math really nice and round and easy. 100's easy to divide by. Out of that 100, 20 million barrels a day transited the Strait of Hormuz. So the Strait of Hormuz accounted for 1/5 of total supply to the global oil market. And
That's
that was
huge.
shut off. Pardon?
Yeah, it's really huge. That's massive.
Yeah, it's massive. I mean, this is something that, again, just for perspective here, I've been an oil analyst for about a dozen years or so now, since graduating from the Monk School of Global Affairs, where we both attended graduate school. Go Monk.
Yeah.
So basically, this was something that had always been discussed. This is like arguably the most known risk in the oil market. It's the type of event that every analyst, when they start out in this industry, is kind of introduced to, and almost as a kind of a thought experiment. Like, okay, Rory, let's first week on the job. Let's say Iran closes the Strait of Hormuz. What would happen, and how would the world break go? And that was kind of an opportunity to kind of go through all the various steps of, okay, well, first we would lose exports, then we would lose imports, then refineries would start turning down operations, and then we'd lose products and all down the way. It was never something I ever expected to see actually happen in my life. So if you had asked me in mid-February, if the Strait of Hormuz was ever going to be closed this year, I would have said very, very unlikely, even with the mounting tension with Iran. Now, I would say the main reason for that is that I never expected the occupant of the White House to be so reckless in pursuing a war and attempting to call Iran's bluff on the Strait, which very clearly turned out to not be a bluff. They can actually close the Strait of Hormuz. So, I never thought I'd see this. Even more bizarre, this long into the crisis, I know oil analysts you would have spoken to 6 months ago. If you had said, the Strait of Hormuz has been closed for almost 3 months, where's the price of oil? We would have been saying $150, $200 a barrel. And at the beginning of this crisis, that's exactly what I said. This is where we expected to go. As we will talk about, I still believe that logic is firm, but the timing is clearly far longer than we would expect. Today, as I'm looking at my screen, Brent, which is the main global benchmark for crude, different from WTI or West Texas Intermediate, the main benchmark for North America. Brent currently is trading at $110 a barrel. That's expensive and almost double where it was prior to the war, but still nowhere near the crisis level that we would have expected.
You know what? You're not alone, by the way, on these predictions. I took my shot at it. I said 140 in May, if this remains closed. And yet you're right, we're looking at 110. This is not like 110 depending on the time people listen to this, but high, but not as high as expected, right? It's quite something for sure. And I want to kind of compare it with previous crises, because you're right, this should be a lot higher. So I think listeners should know that, and these are just rough numbers, but based on what I found, the OPEC crisis and the Gulf War, that was around 7% of all oil went off the market. The OPEC crisis, I've seen numbers saying that was for 5 months, the Gulf War for 2 months. Regardless of the time, the point is that was 7% of all oil off the global market. But Rory, what we're looking at is it's almost been 3 months that the Strait of Hormuz has been closed. And this is, I think, I've seen 15 to 20% of all oil off the world market. So why hasn't it risen as much as expected? It's risen a lot. People on Memorial Day, or those of us in Canada on Victoria Day, were kind of annoyed to fill up our cars, but it could actually be a lot worse. So why has that not happened? Why is it taking as long as a lot longer than many people would have thought?
Yeah, so let's kind of go down to what I call the barrel counting side of it. So let's go through the math of what is happening in the Strait of Hormuz. So we start with that 20 million barrel a day number. So that's our first number, 20. From that, we begin to take away some aspects, some legitimate rerouting that has occurred. So of that 20 million, for instance, the single largest rerouting effort successful has been in Saudi Arabia, where the East-West pipeline takes oil from the east in the Gulf, basically, yeah, by the Gulf side, all the way to the west of Saudi Arabia, out the Red Sea. That pipeline is roughly 7 million barrels a day of capacity, but it was transporting before between 2 and 2.5. So that means you roughly have, let's say, 4.5 million barrels a day of capacity on that line. And that has been utilized. So now the Saudis have maxed out the East-West line. They've maxed out exports at the Red Sea. And that's taken roughly that 20 million barrel a day number to just over 15. So that's a big chunk out. You've also had a couple of additional reroutes. There's a UAE pipeline. The Emiratis have a pipeline to the port of Fujairah on the Omani coast, like on the Gulf of Oman side, that reroutes around.
Wasn't that struck though recently? I remember that was a couple weeks ago. We actually don't even know who struck it necessarily, but yeah.
Yeah. So Fujairah is, for those that aren't aware, Fujairah is a critical bunkering, basically a bunkering port. So this is where ports go to actually refuel themselves in addition to get the oil to transport, but actually like the ship fuel itself. It has been attacked repeatedly, like a dozen plus times, I believe, over the course of the war. And you have had disruptions, but despite those disruptions, the Emiratis have continued to pump more and more volume out.
Oh, interesting.
So you have, there was roughly, let's say, maybe 1 million barrels a day on that line before, and they've jacked it up to, let's say, 1.5, 1.7. So, these are modest, but they help. And I think in a crisis this large, anything helps. You also have, for instance, an Iraqi pipeline that goes to a port in Turkey on the Mediterranean that can also put out, let's say, 200,000 barrels a day. So you have a little bits and pieces all around, all together. And I think the final piece of this was that Iran, up until very recently, continued to export its oil out of the Strait of Hormuz, which is another thing that if you had asked me 6 months ago, would the Strait of Hormuz be closed? No. If it was closed and the U.S. Navy was floating off in the Gulf waiting on the other side, would Iran continue to export its oil? Obviously not. But clearly that was also true until the blockade was firmly imposed about a month and a bit ago. So altogether, of non-Iranian oil in the Gulf across the Middle East, you have about 13 million barrels of that initial 20 that couldn't get out at all. And adding in that Iran has now been blockaded, let's put that up to about 15 million barrels a day.
Yeah.
Basically, when you don't have anywhere to put it, when you don't have ships that are empty that you can load, then you begin loading inventory, basically these large storage tanks on land. They don't have that much capacity. So after you run out of tankers that are empty that you can fill and onshore storage, you can't just pump it onto the sand or into the ocean. So you need to shut in wells. And that's essentially what's happened. That right now is the most important loss to the oil market. The barrels that have actually gone unproduced. Yeah. So of that, let's say 13 to 15 million barrels a day that is currently not being produced in the Middle East now, the cumulative total of that is circa right now around 800 million barrels that were supposed to be produced this year that now have not been. Add in the recovery times and restart times, we're easily talking over 1 billion and probably around 1.2 billion barrels. That's a crazy amount of oil. That's the biggest picture that we've lost.
No, it's a lot. So you're right. We have some of this rerouting. So it's thankfully. And I think also listeners, because everyone's probably like, well, what the heck? Things are bad at the pump. But like people, like this could even be worse. And you're right. There's been some rerouting through Saudi Arabia, through Fujairah, through Iran. Well, until recently, the pipeline from Iraq to Turkey. But we're still looking at a massive loss of global oil. So that still begs so it's been partly, very slightly, anything helps, but why fundamentally, this is a huge loss. Why haven't prices gone up as much as expected when we count for all that?
Yeah, so there's a couple things. And I should say, mea culpa, I thought they'd be higher by now. And in any other year,
You and
any
I both.
other environment, I think we would have been. So
Yes.
what's unique about this moment and the policy principles that are at play here? I think importantly, and I think very importantly going into this, the oil market was very, very weak going into this crisis. We had been notably oversupplied. We were currently seeing, let's say in January, February, at the end of last year, we were seeing the largest surpluses, supply surpluses in the market since 2020, since COVID. That was driven largely by OPEC's attempt to regain market share by lifting production. They had cut a bunch of production. It didn't work out that well. Prices were still falling. So they basically wanted to reclaim that market share, and that was sending the market into a free fall. Over that period, you built up a lot of stocks. You built up a lot of inventories because if you have too much supply or more than demand, you store it. So that built up a buffer. That is legitimately something that, let's say, didn't exist in 2022 when the war started, when Russia invaded Ukraine. We had very, very low inventories because we had just come out of COVID. We had just come out of the supply chain bottlenecks. So we were much more precarious then than we were now. Arguably, of any moment, this would have been the best moment. The market was most defendable from a kind of a supply perspective in this moment. This doesn't explain all of it, but explains some of it. And it explains the fact that there is fundamental runway of buffer in the market that we still do need to work down. Now, I should say, we are working down that buffer at the fastest pace stocks have ever been drawn down in history, but they are being, but we do have a lot to draw through.
No, so you're right. It's kind of like if there was a food shortage, but we have a lot, like, we have our little doomsday bunker filled with, I don't know, ramen noodles and Twinkies and all that. Like, we can wait this out. But the problem fundamentally is at a certain point that will be drawn down.
Yeah, these are not flows. These are stocks that are inherently finite.
Yeah. So one thing I think people should know about for, all listeners. So I know like the United States, there's strategic petroleum reserves, for instance. This is, and you can correct me on this, my understanding is that it's kind of self-explanatory. This is oil meant to be kept in the case of a crisis. How quickly are those being drawn down? Like at the current rate, how much more time is left before we're getting to zero, for instance?
Yeah, so in the reserves right now in the United States, you have ballpark 400 million barrels. Across the entire OECD and IEA member states, this is the International Energy Agency, the entity that was created coming out of the 1970s oil crises, specifically to help consuming nations manage their vulnerabilities to this sector. So those, you had the large, this was in March, you had the largest coordinated IEA release of strategic petroleum stocks of about 400 million barrels. That's a big deal. That helps a lot. And now I should say it's still only half of what we've already lost in the market. So it's not like a magic bullet, but it helps. And I think importantly, these are not barrels that are normal market barrels. I think for a lot of people, when they think inventories draw down, that means prices go higher. In most cases, that's true. But in this sense, strategic petroleum stocks are not inventory. They are a policy lever. They're a policy ammo, essentially. That when the market internalizes that release, it's not as an inventory drawdown, but as a supply injection that goes into the rest of the system. So that does help offset some of the loss. As an example, so this last week in the United States, we had, I think it was 8.9 million barrels of crude released from, or actually it was 9.9 million barrels of crude released from the US SPR, which was the largest weekly release in the history of the Strategic Petroleum Reserve in the United States. That's a run rate, and again, because we measure all of this in millions of barrels per day, because the oil market is a big flowing chemistry set, that's about 1.4 million barrels a day, and that's the fastest the United States has ever drawn down the SPR. At the peak of the Biden drawdown in 2022, you hit just shy of 1.2 million barrels a day. So this is faster than even that. And just for reference and just for context here, very notably, the Trump administration, and particularly Energy Secretary Chris Wright, has frequently lambasted the Biden administration's drawdown of the SPR in 2022 as something that was way too fast, that drawdowns of that pace would damage the reserves, For reference and for record, That is not what would damage the SPR in the United States. The SPR, by its very name, was designed as an emergency battery of oil. It was exactly designed for these massive, punchy releases. What it was not designed for is how the SPR had been used for most of the past decades prior to 22, which was small releases here or there, a little disruption from a hurricane in the Gulf or whatever. Those are those types of releases that were actually quite bad for the reserve. And I'm actually glad that, for its credit, we in the largest supply shock in the history of the oil market, we should be seeing the largest U.S. drawdown of its SPR on record. That actually is what they should be doing. Another point of criticism, however, is that these releases had not started as quickly as they could have.
Oh, interesting.
A big part of that was that they were structured. There's two main ways of releasing from the SPR in the United States. You kind of do an emergency release, which is, as it sounds, you basically just say, hey, all this oil's for sale, buy it. And that's really fast, right? The other way, and what the Trump administration did, was you can structure them as exchanges. So basically, you lend the oil to the market, and you structure the contractual agreement as rather than paying interest in dollars, you pay interest in barrels. So let's say you pay, you take 1 million barrels out now, and you return 1.2 million barrels in a year. That's kind of how these things are structured. But because of that additional complexity, it took longer for private sector participants to take that oil, because then they had all those messy other arrangements to make on the other side.
But fundamentally, so we're looking at 9.9, let's just round it up to 10 million barrels. And you say there's 400 million roughly in the strategic petroleum reserves. That's 40 weeks. Like, that's not forever. That's not forever. So again, look, we have some buffers. We have, okay, cool, Saudi Arabia, Iraq, Fujairah, awesome. We have these strategic petroleum reserves. But what you, myself, and others keep looking, it's pretty much like, the way I see it, is a car that's rapidly approaching a wall. And so going back, why, in addition to these factors, in my opinion, I think the prices are low simply because the markets are naive. And I'm actually going to explain why that's the case. Because when we're looking at, for instance, Brent, I think one thing listeners should understand is the difference between, actually, maybe it's better if you explain this. So when we turn on the TV, you see Brent, WTI, these prices. People should understand this is actually for a future contract versus a spot price. Can you just quickly explain to our listeners what that difference is?
Yeah. So when oil is priced, any oil price you see ever, anywhere, is going to be for a certain grade of crude in a certain location in a certain point of time. And each of those three pieces is really, really important. So as an example, Brent is a light sweet crude priced in the North Sea. WTI is a light sweet crude priced in Cushing, Oklahoma, in the middle of the United States. And Canada's main export grade is known as Western Canadian Select, which is a heavy sour grade of crude located and initially priced in Hardisty, Alberta. Those are three very, very different locations that all have very, very different logistics and and market realities to them. To your point, it's also important to note that when we see the price, what we're typically talking about is what we call the prompt futures, or the front month of the futures curve. So when you look out and, right now, so Brent, for instance, is trading July barrels. So if you look at the price right now for Brent, what you're actually seeing is not for this month or next month, but for the month after that, for July delivery. That allows a lot of speculation to a degree, I think particularly in these kind of volatile, chaotic moments, to say, is the strait still going to be closed in July? Or in April? Was it still going to be closed in June? Or, we can go back all the way. So what we have seen is that one of the main ways that the market has manifested this crisis is through exceptional blowouts in backwardation. Now, this is a jargony term that we use in the oil market and commodities markets, and essentially all it refers to is the shape of that futures curve. So if you can picture with me for a second, if this is spot prices or delivery for today, and you have a backwardated market, which is essentially there's a premium for spot delivery relative to the future. The curve looks like this, right? It slopes down into the future.
Yep.
And the opposite of this is one of the best words in commodity markets, something called contango, where you have a discount on spot markets relative to the future. All this is telling you is whether or not the market is in surplus or in deficit. When the market is in surplus, we have a contango curve, which essentially pays for storage. When we have a tight market, backwardation, because you essentially create an incentive or an opportunity cost to not releasing those barrels in the market. And so it's that backwardation that's actually creating the economic incentive to draw down inventories in the first place.
Exactly. In other words, like the way I see it is also this means that these people, the commodities traders, believe that the price is going to come down in the future, right? So that there's going to be, like, if we have contango, that means things are going to be going up, probably more pessimism. Is that fair to say? Whereas backwardation usually implies things are going to get better. Like if spot price right now is whatever, don't worry, July contract, it's going to be all figured out. Is that fair to say?
This is a way it's often interpreted, and I think it's wrong. And I think when you have like your macro folks that are looking at this market, that's what they're saying. When you look at a lot of the kind of optimism in the broader equities and broader markets outside of oil right now, they're looking at the curve and saying, look, and you've even had Trump officials like Kevin Hassett saying this explicitly, saying, look, the curve is pricing X dollars lower in a year's time. Clearly, it's not a big deal. But when we go back to all it's saying is whether or not markets are in surplus or in deficit. It's not a forecast. And that's the important piece of this. All it's saying is that right now we have, so the difference between July delivery Brent and August delivery Brent is about $5 a barrel right now. That's saying that the barrel in July is $5 scarcer or more valuable than in July. All that's basically saying, and basically when we are going to the spot, what we have in Brent, it's called dated Brent. This is basically even further, towards the present. That's another $5 above where, prompt futures are trading. All this is basically saying that right now there's a big supply hole in the market, and the curve is creating an economic incentive, or basically an economic opportunity cost for holders of inventory not to dump them into the market, which is why we're seeing such rapid reductions in prices.
Right.
But I think there's been a little bit of this narrative that futures markets are manipulated. And I think that this likely overstates the case. I think that while anything is possible, and I would not put anything past the Trump administration, both Treasury Secretary Bessent, as well as, it's not just the United States. The Bank of Japan, the Central Bank of Japan, has also talked about potentially intervening in futures markets because oil prices being high is really bad for the Japanese economy and bad for the yen. So there's lots of incentives, lots of people. Basically, everyone not in the oil industry has an interest in oil prices being lower. So there's a question like, are they directly manipulating this? And I think one of the pieces of that was especially compelling at the beginning for a lot of people was this spread between futures markets and spot prices. So what we saw, on the beginning of April, on April 7th, this is the day that the ceasefire was announced. That day, dated Brent, that spot benchmark, hit an all-time high of $144 a barrel, and I think it was 62 cents. Yeah. On top of that, because again, while that's closer to spot, it's not quite spot. Usually dated Brent is delivering 10 to 30 days forward. On top of that, you had physical participants in the North Sea, offering to pay $20 a barrel above that for physical delivery. So in early April, you were already seeing basically physical crude deliveries happening at $170 a barrel. Well above the kind of like 115, 120 that we were seeing for, I think at that stage, it would have been June Brent delivery. But while a lot of people said like that's evidence of manipulation, in my mind, that is just more backwardation. It's the same thing. It's basically just a screaming market that's saying, give us all your barrels today.
But needless to say, though, so at the end of the day, so we have so many things like I think, I know I always have a mixed view on these things. Like part of me thinks like the market has a certain rationality, reasons, narratives behind it. Things aren't random, of course, but I do think markets, can also get things wrong. So, people might say, well, eventually the prices go catch up. And I'm not necessarily Keynesian, but I also agree with John Maynard Keynes when he says, in the long run, we're all dead. So like right now, I think, and I'm going to share you my view on this, and you can correct me on this or give your take. My view is that fundamentally the commodities market is optimistic and naive. And the reason for this is because, as we said, Brent, we're looking at a July contract. This is what I'm confused by. If the Strait of Hormuz opens today, like you and I are recording this, our phones go off. Oh my gosh, Trump is signing with, the Ayatollah. It's all good. Everyone, you can calm down now. This is what I'm confused by. Even if the Strait were to fully reopen today, there's a couple of things that are needed before those shipments of oil can reach all their global destinations. This would include, for instance, it takes 40 days for ships leaving the Persian Gulf to reach North America. There are mines in the Strait of Hormuz. I saw one article, I believe, from the Wall Street Journal saying 6 months to possibly clear those mines. I also saw, for instance, another similar case. We had, I think, a year or two ago, the Houthis, who are actually known as Ansar Allah in Yemen, they closed off the Red Sea. They blockaded it. The blockade came to an end, but shipment has not resumed like normal. I think I've seen 50, 60% less compared to before. So the way I'm looking at it is, in the best case scenario, oh my gosh, we get a deal today, fantastic. Even, July is like 40 days from now. So how could Brent not be hitting close to record prices if we're not even going to have the normal resumption of oil by July, even if the Strait opens? Like, explain this to me. I'm just so dumbfounded by this.
Yeah, so let's talk about a couple things here. So the one, let's talk about the comp to the Red Sea and the Bab el-Mandeb Strait and the Houthis' closure of that a couple years ago. And you're right, it has not recovered. A lot of that traffic is still going around the Cape, the southern coast of Africa. Mm-hmm. The main difference there is that you have the Cape. You have optionality. There is no other option to the Strait of Hormuz. So if it was to reopen, you would have people pushing stuff out of there pretty quickly. Because if Iran stops shooting at stuff, it's going to open pretty quickly. To the mines, here's the thing with the mines. No one knows exactly if they're there, how many there are. These briefings, for instance, the Wall Street Journal, this is a report of a briefing by the Pentagon to Congress that was classified that someone leaked. That is basically, it's true that and they're basically saying that it would take 6 months to guarantee the clearance of these mines, and possibly even longer because the US has recently decommissioned a bunch of their mine sweeping ships, everything else. But I think there have been lots of passages through the Strait of Hormuz since the closure, and since these mines have apparently been there, and we have not yet seen evidence of any mines. And it should be noted that, like everyone in this conflict has an incentive to, let's say, an incentive for hyperbole, let's say, to exaggerate the extent of reality in certain ways. Iran has a strong incentive to say, yeah, we mined the crap out of the entire strait. You have to go. The only safe way is to go through our kind of Iranian toll booth channel. So that is part of it. I'm not saying there aren't mines. I'm sure there are a couple. We had,
of course there are, yeah.
But it is a question of of how many there are. And if you did have enough of them, you would have expected that someone would have hit one by now, given that many ships had been trying to cross through, including, for the record, the US Navy has a couple times put ships back and forth through the strait, kind of in an attempt to show, look, we made it through without blowing up. You can too. This was the whole premise of Operation Freedom or Project Freedom. That's what it was called. Can't keep track of all the names they're coming out with. The
names are so goofy.
they're very, very, very goofy. So I do think that that's part of it. I should say your core premise that the market is overly sanguine, kind of Pollyanna-ish about the entire situation, I absolutely fundamentally agree with. And I think that in any other scenario, any other reality, we would be much higher. I think the one idiosyncratic element here, and while there hasn't been any evidence that I've seen anyways, that you have had direct manipulation of markets by, say, Treasury or the Bank of Japan or whatever. There's lots of rumors, lots of people throwing accusations. I have yet to see any evidence. What I think is a more Occam's razor explanation of what's happening is that while you're right, and I like to think I'm right, and yes, the market is bullish, fundamentals are bullish, but someone has to actually put money on that and bet on that in order to let prices go higher. That's how this is all going to work. You need more buyers. And at this stage, no one wants to be seen as the guy who overpaid for oil if tomorrow it all ends.
You're going to lose your job potentially.
Yeah, I mean, a lot of people did. A lot of people have lost their jobs, and I think one interesting element of this crisis thus far is the degree to which Donald Trump personally has kind of verbally intervened in the market with all of these proclamations. Literally, so it was, I think it was the 8th day of the war, the second Monday of the war. He basically said it's basically over. I think that was like March 8th.
And famously, Donald Trump never lies, so that makes
yes. but I think at the end of the day, right? I think that everyone knows that Trump lies. Everyone in the market knows that Trump lies, and everyone knows that everyone else in the market knows that Trump's lies. But at the same time, at the end of the day, when this does eventually end, it will be a decision of Donald Trump overwhelmingly. I think we can debate about what Israel's going to do and what Iran's going to do and everything else, but at the end of the day, the person that is most movable by external influence is Donald Trump. So the way I see this going, the way I see this all ending eventually, is basically oil prices rise, equity markets begin to fall back, the pressure builds on Trump until he eventually is forced to cede some kind of ground to the Iranian negotiating position, likely on the nuclear file, likely on domestic enrichment, likely on the status of the highly enriched uranium, or as Trump refers to it, the nuclear dust. This, I think, is probably what will happen. And at that stage, Iran will say, great, welcome to the club. Probably shouldn't have declared war on us and attacked us. And now the strait's ours. But, whoop-de-doo, now we'll go back to something more akin to normalcy under our control and kind of propping Tehran into a position of global influence it, quite frankly, hasn't enjoyed since the heyday of the Persian Empire. So I think this is something else that's happening that I think is unique. But again, if you're a trader, if I traded futures, which I don't, thank goodness, but if right now we're sitting at 110 Brent, I would tell you fundamentally all the risk is to the upside, right? Hormuz is still closed. We're draining 1 billion plus barrels from inventories. The war has not, if anything, Trump is talking about potentially restarting open warfare.
It seems like war is actually more likely than a deal at this point.
And I would right. So I would say overwhelmingly risk is to the upside. But if you look empirically, and given that so much of this is now driven by algorithms and computer models of it as well, algorithmically, and you look back empirically, the last 3 months, once you're at 110, there's much more risk that you have a $15 a barrel drop to the downside than you have a $15 price spike to the upside.
Are these algorithms, by chance, Rory, are they taking into consideration Donald Trump's tweets? Because, in my opinion, I don't know how these models work necessarily, but sometimes he just puts out something. I don't know if there's some sort of look, I'm not a coding AI person, but a part of me does wonder, he'll just put out something kind of generic and then prices drop a lot. I'm always shocked by that. I know, but maybe also one thing I should tell listeners, this, of course. I think I'm seeing a couple of graphs every time Donald Trump puts out this positive news. Is it also true the price drop is becoming less and less? In other words, people are buying it less and less. That's correct, right?
Generally, yeah. I think there was a $30 intraday sell-off on that first Monday. The second Monday of the war. Was it, March 8th or 9th or whatever that was, March 9th. That was, you had a massive drop. And each time it is, you've had different levels of sell-off. But I do think, for instance, various moments were more important, the declaration or the announcement of the ceasefire took a lot out of oil prices, both futures and physical. That was the day you had dated Brent hit 144 record on April 7th. Right now, dated Brent is at $115. So it's it's high, but it's not rocking, right? So I think there is that was a real shift in the risk calculus I think the market saw that was probably justified, even if I still think that overall oil prices need to be higher than they are right now, if only to push Trump off of his negotiating positions.
And this is where we go back to the people who lost their jobs, because there's people who saw that it went up and then crashed $30, and those people people looked at that and they're like, I don't want to be the person to be betting on higher prices, and it doesn't happen. That makes a lot of sense. Well, look at you and I. I'm a geopolitical analyst, you're a commodities analyst. We also thought prices would go a lot higher, and yet they haven't. So that's very interesting. Going back to though my assessment of the naivete of the market, it's like that. Have you ever seen that meme where it's like, no, you are all, it's like the one person, there's a huge crowd. It's like, no, you are all wrong. And I do feel like I'm in that position, and I'm always open to correction. But I will say this. So I find sometimes there's a bit of a disconnect also between commodities analysts and geopolitical analysts. I found it interesting. Many commodities analysts were surprised Iran closed the Strait of Hormuz. I was not surprised, and other geopolitical analysts were also not surprised. And this does go back to my point on maybe a bit of naivete or optimism, because yes, Iran and the United States are going to reach a deal at some point. But I think the issue of the Strait of Hormuz is actually a huge sticking point. I'm going to explain why. Iran absolutely wants to control the Strait of Hormuz for several reasons. It could charge a toll that would generate billions of dollars. But from a geopolitical perspective, if Iran controls the Strait of Hormuz, this gives it huge leverage over the whole region, the Gulf states. It solidifies its position. It becomes a mid-tier power. Now, this is where I'm going a little maybe controversial, because I think the reason why the United States doesn't want that is because of something called the petrodollar, which I want to hear your thoughts on. Because in my opinion, the United States absolutely needs hegemony over West Asia because of the petrodollar. For listeners, the petrodollar is the fact that I believe 80% of all oil is traded in US dollars. That keeps the value of the dollar artificially high. It also gives the United States significant leverage. So one thing I saw that was interesting, for instance, last month, Iraq was actually requesting $700 million of physical US cash for its central banks. And the United States said, well, you're only getting that if you get your militias under control. So in my view, the US dollar is absolutely critical to all this. And I don't mean in a weird, like, oh, let's get onto Bitcoin or the gold standard. I'm not even talking about that. I just mean from a geopolitical perspective. In my perspective, Iran wants to keep the Strait of Hormuz because this is going to solidify its position. The United States doesn't want to give it up. And it's a zero-sum game. The United States really can't give that up because it puts its whole monetary economic system vulnerable. So I don't see negotiations coming to a conclusion anytime soon, even just for this specific reason. But I want to hear your thoughts on that.
A couple things. I would say that on the kind of geopolitical versus oil analyst view of, say, Hormuz, I should say that I've been in this industry probably like a dozen years. I think I've heard that the Strait of Hormuz is going to be closed every year for a dozen years. And I think this is the thing. The reason that generally, even prior to this, I was a heavy seller of any geopolitical spike is that typically the oil market actually overreacts to geopolitics. When you think about what geopolitical risk is really, it's a handicap on supply impact in the oil market as we talk about it, really. So what you're talking about is, let's say, war is happening in the Middle East. That means you have X% higher probability that, say, a Saudi oil well gets bombed or the Strait of Hormuz gets closed. The difference right now is that this is no longer a geopolitical risk. This is a supply shock, right? Mm-hmm. The risk was in February. We could see this was mounting. Yes, I would say that again. I did not think that Trump would actually be foolish enough as to actually do this. Yeah. Because again, I mean, and we can say like Israel pushed them, which but Israel's tried to push every U.S. president for the last 30 years to do this exact thing, and they've never done it.
I just want to interject because it's funny. I had actually 2 days before they hit Iran, I had a video out. I said, it looks like they're going to hit Iran. The only reason I don't think they're going to do it is because this is a very stupid thing to do. Yeah. And in a way, I was right. It was stupid, but they did it. So,
I would say like that's the kind of thing is like no one, again, there were questions about Iran's capacity to close the strait. Because again, I think when you look at, for instance, back to the tanker wars in the 80s, you had a lot more ships sunk. You had like something like 400 ships attacked in the tanker wars of the 80s. This is during the Iran-Iraq war. During that period, you never had a cessation of flow of oil through the Strait of Hormuz. You've never had the Strait of Hormuz closed ever in the history of humanity. I think this was a pretty big tail risk. And I think even when the view of even if they did close the strait, the assumption was the impact would be so grave that the entire collective might of the rest of the planet would come down to bear, which again, Trump has tried to do since. He's tried to get his coalition, he's tried to get the Europeans and the Asians to come in with militaries to try and forcibly reopen the strait. And everyone's like, no, you made this mess, you clean it up.
Absolutely.
So I think that is it. I'm not as much of a worrier about the petrodollar, to be honest. I think when you look at the US dollar's hegemony in the global system, there is no real competitor, right? Whether it's, and I think at the end of the day, if you don't have, you need some kind of like lingua franca of global commerce. And even when you're looking at dollars recycled from, because back in the 70s, absolutely, that was like the biggest inflow of like foreign dollars into treasuries was absolutely coming from the Gulf. Now much more of it is coming from kind of dollar recycling out of Asian export giants, which are shipping, Taiwan, shipping chips out and everything else. This is all supporting it in the same way. And even if you did have kind of, if Iran did threaten this, Iran would have to say that like no ship could pass if its bill of lading is denominated in US dollars. It's just kind of weird. Like in that situation, like they could be charging a toll or whatever, but I don't think it would inherently impair the global petrodollar flow system. And for the record, what for people that aren't aware of what this is basically just these Gulf exporters have massive export surpluses, massive current account surpluses, and they need to reinvest and kind of funnel those dollars somewhere. So they funnel into U.S. Treasuries and U.S. equities and everything else, and that helps support the U.S. dollar. The alternative is like, where else are they going to put it? They're going to put it into China with a closed with a closed current account. Are they going to put it into Europe? Well, not that attractive in a whole bunch of ways. So the U.S. dollar is like the U.S. dollar has this issue, or any challenge to the U.S. dollar has an issue that there really aren't that many attractive challengers. For the while, people were talking about the euro, the sclerotic euro system has its own challenges.
But I don't think it necessarily, Rory, has to be, and I'm not going to belabor this too much because you've already been on for a while, and this is we're talking about. I mean, it's all related, but like, oh my gosh, I could go on about this. I have my own strong positions. I've written on this. But needless to say, I don't think it's going to be so much a currency will take the place of the US dollar. I think it'd be a greater diversity. And we are seeing that in terms of foreign reserves. Not quite in trade. I definitely agree with that. But I think that is what's going to happen. There is also banking systems that are being developed that do not require the US dollar as a common currency, as a currency of exchange, as a lingua franca, as you said. So I do think there is fears in the United States around this, but maybe because I am actually going to cut this off, not because I disagree, but I think we could go on about this. But needless to say, so forget the petrodollar. I think regardless, negotiations are going to be extremely difficult because there's a nuclear file, there is the Strait of Hormuz, reparations, these other things. When I look to other negotiations in the region, whether Israel-Palestine, Israel-Lebanon, when I look at big conflicts, Russia-Ukraine, I don't see a lot of examples of things going really quickly in processing. And I think this goes back to my whole thing that I think the market's naive. They're not even having face-to-face negotiations right now. They're sending things and using Pakistan as a intermediary. So,
and even that's pretty loose right now.
And that's really loose. And as we said earlier, it's probably more likely war and rockets firing and all that is more likely than actually a deal. So I guess that's all to say, is it not fair to say that the markets are a little overly optimistic? Even when we count for everything?
Yes, absolutely.
Okay,
on that, I will 100% agree with you. Again, I think that at this stage, crude prices should be higher. Any kind of rational read of this, even accounting for all, and again, I've done my kind of legwork of you can make sense to a degree.
Of course you can.
Of the lack of reaction thus far. But I think at the end of the day, you cannot get away from the fact that the world is currently short 10 plus million barrels a day of oil. And that at the end of the day, if this persists, you're going to need to destroy that much demand. We have never destroyed that much demand in the history of the oil market before. And it's not gonna, and that's why when people are saying that we've already seen it at like, the reason we're capped at 110 is because demand destruction's happened and it's done. Like, absolutely not. Like, there's no way that we've destroyed 10 million barrels a day of demand at $110 crude. Yeah. And even when you have additional pricing pressure in jet fuel and diesel and gasoline and everything else, because refining margins have also exploded. So that's another piece of this. So you and I don't pay the price of, Brent crude at the pump. We pay gasoline plus a marketing, margin and everything else.
Petrol for in the UK, yeah.
Yeah, so I think that all this together is one of these things where, right now, for instance, Brent's trading at 111, but the gasoline crack spread, or effectively the refining margin for gasoline, is over $40 a barrel, which is double the seasonal norm for this time of the year. So that means that right down on the screen, without any additional elements, we're paying over $150 a barrel for gasoline right now.
Yeah.
100, diesel right now is at 64. So we're paying over $170 a barrel right now for diesel.
We're both based in Toronto. It's I'm looking at the prices. It's getting closer to $2 a liter, which for the American audience, I did the math. This would be like $5.50 a gallon. So it's very close. I think the highest Toronto hit, for instance, was nominally, not accounting for inflation, was $2.1 per liter. So we're getting very close to that position. Okay,
we'll get up. And also for that reference, that included carbon tax. So now we don't have the carbon tax in there. So even that comp has a little bit. So that I think point. If you had the carbon tax in there, we would be much closer to that $2.10 as well.
Yeah. Well, now I want to run just a couple scenarios for you, because a lot of people, like myself included, were kind of all wondering, and just a couple more questions. When the poop's going to hit the fan, to put it in a PG way. So the first thing is, Rory, let's just assume the following, just the status quo. So what do I mean by that? There isn't a resumption of the war, so you're not seeing these gas facilities getting blown up. Trump every 7 days tweets, "Oh, negotiations are going great. Yay, excellent." But the strait does not open. At what point do you think we could be seeing record prices for like Brent and WTI if this continued indefinitely?
Yeah. So what are we talking about here? Basically, we're talking about $140 plus Brent. When is it going to, and that's for futures. So that's assuming dated Brent's going to be higher, physical delivery is going to be even higher. So physical delivery, we're going to hit, in this scenario where we hit record Brent futures, probably physical delivery is over 200 at that stage already. When is this going to happen? I think probably July. I think at this stage, I think if we remain closed, I think my modeling, I did this, I published a piece a month and a bit ago called the Sanguine Strait Stoppage, where I tried to make sense, tried to be as charitable as I could with the market and say, let's make sense of the market's reaction. I could make $100 crude make sense in kind of mid to late April, given those buffers, given where inventories were, everything else. But even using that kind of very sanguine model, assuming the run rate, assuming Hormuz remains closed, and we're still drawing 5 plus, and I super charitable, and I put half of it on commercial stocks, that puts us at all-time highs by the end of June. We're getting very close there already, though. Again, it's only a month and a half away, and it feels crazy to think that we're going to see a 50% spike over that period, given how sanguine the market has been.
And again, I think we've also I'll say this quickly, we've also become weirdly too a lot of people have become too optimistic, because I think there's this idea that as soon as Iran and the United States meet in Pakistan, things are going to go great. But last time we got a ceasefire, but we didn't get actually the resumption of the Strait of Hormuz reopening. These things can take a very long time. So I think we are closely approaching that wall. A couple other scenarios. So at what point do you think, another thing people are looking at is plane flights, because I know the jet fuel, we won't get too many details on this, but just I know jet fuel is also an issue right now. Do you think around that same time we could see the mass cancellation of flights, for instance?
I think before mass cancellations, you're going to see a lot of price spikes. So anyone that's planning late summer trips to Italy, I think that's probably going to be a pretty risky proposition, or Australia for that matter. I do think, however, that at the end of the day, most of these places we're talking about, if you're traveling somewhere in the advanced world and you're traveling on a flight like that, you likely are wealthy enough and you likely have you likely have the spending power that you're likely going to pay that to, let's say, get home. Like, you're not going to get stranded. What that means is that you will need to pay a high enough price to incentivize that barrel of jet fuel away from someone else that can't pay that much. So what this is likely going to do is it's going to drain excess or drain jet fuel from emerging markets, the global south, into the global north, into advanced markets. And I think that is what's going to fundamentally happen. We've already started seeing, for instance, in the peak of European flying season, half of their jet fuel is imported, and half of those imports historically came from the Gulf. That has largely been replaced in the interim by exports out of Nigeria, the new Dangote refinery in Nigeria. So you're seeing African kind of jet fuel being sucked into Europe because they're willing to pay a higher price for it.
Right. And so maybe don't cancel that summer trip, but especially if you have the money for it. But I guess people who, again, this is also a huge thing that's going to be on its own podcast. I think listeners should also understand the global south. People like us are worried about paying more at the grocery stores, etc. But the big issue is the global south, like food. Even this is going to be a big issue over the next year because, of course, the Persian Gulf is also necessary for fertilizer, for instance. So yeah. Okay, the final, just two more. So two more things. Finally, could we see OPEC level crisis? Like, remember during OPEC, you and I are both millennials. We don't actually remember OPEC, the OPEC crisis. But could gas stations actually run out of oil? Is that something that could happen if the strait remains closed indefinitely?
If Trump is stupid enough to go with some of the trade and price restrictions, because I mean, the thing about the 70s crisis, those gas lines and those physical shortages were largely a result not of the OPEC embargo, but of Nixon's price controls.
Interesting.
When you cap the price of fuel, it means you can no longer afford those imports, and the wholesalers can't bring them in.
Right.
That's what would short circuit this. So as long as trade, everything I was saying about how the wealthy nations will likely remain, made whole with the fuel, that's only true so long as trade can flow. If you start restricting trade, which is a concern in the United States this summer, that's what will end up causing shortages. So I think as long as trade remains free, prices will dictate the flow. Otherwise, policy is going to do it.
So I think it's one of my final questions. So we've talked all about all the bad stuff, and it really is bad for everyone, this whole crisis. Who do you think the winners are, though?
So I think basically the winners of this crisis right now is any oil producer not on the bad side of the Strait of Hormuz. So I think if you're looking at individual countries, I think Russia is, a pretty clear one.
I'd agree with that.
That's why Ukraine has stepped up attacks so dramatically against Russian export ports to try and prevent them from capturing this windfall profit gain. And the U.S. Treasury has continually actually waived sanctions on Russian crude. So again, I don't often say things, nice about the Trump administration, but to the Trump administration's credit, they had actually done a good job at clamping down on Russian oil over the 6 months prior to the Iran war. All of that progress had been undone in the matter of weeks. So they're a massive beneficiary. And I think we're sitting here in Toronto. I think Canada is on a net basis, likely a beneficiary of this, given the fact that it will, increase the attractiveness. Obviously, it'll increase the prices we're getting for our oil exports. It'll increase the attractiveness of investment in kind of secure jurisdictions like Canada. And given the fact that the major political kind of project in this country right now of industry and of people like myself is getting another West Coast pipeline to diversify our exports away from the United States. Well, this just makes that much, much more attractive and kind of urgent than it would have been historically.
I totally agree with you on a lot of this, especially Russia. I actually did a video about this a month ago. Huge beneficiary of this. Russia is one of the largest oil producers, but even more to that, it gives it significant leverage on the world stage and even over Europe, for instance. So this thing has actually really backfired in terms of Western geopolitical strategy. And I think that we are going to be in this for the long haul. I think that people shouldn't necessarily cancel their summer trips, but keep an eye out for how things are going forward. Rory Johnston, I really appreciate having you on the podcast. Your insights have been incredible. I will be quoting you on whether oil hits 140 in July. We'll see how that goes. I know these things are very hard to predict. and I really appreciate your insight. So this has been the Simardone Show. Thank you everyone for listening, and we'll be out with a podcast again next week. Cheers.